Welcome back. I'm Majid and this is the Financial Crime Awareness Hub. If you watched part 1 of Domain C, you have already a strong foundation. The risk-based approach, customer due diligence at all 3 levels, beneficial ownership, EDD, source of funds versus source of wealth, and the full PEP's life cycle. If you haven't watched part 1 yet, I would recommend starting there. The link is in the description. In this video, we are complementing Domain C, and the topics we are going to cover in this video are the most important ones, such as the compliance programs, how it succeed or fail, suspicious activity monitoring, tipping off, safe harbor, record keeping, sanctions screening, staff trainings, and much more into that. These are the abstract regulatory concepts. These are the decisions your program will make, whether fail or succeed. There are 36 questions from this domain, and which actually carries a 30% of the exam weight. Before we dive in, here's a quick overview of everything we're going to cover today. 7 topics, and each one builds on the last. We start with suspicious activity monitoring, how you detect it, investigate it, escalate it, and report it. Then we will look at tipping off and safe harbor, the 2 rules that work together, one protecting you and one that can get you prosecuted if you break it. Then record keeping, because what you don't document, you cannot defend. Sanctions compliance, one of the highest consequences area in the entire compliance space. Staff training, who needs it, what level, and how often. Compliance officer's role, independence, isn't it? It's not an optional. 7th, the internal control and audit, how the program tests itself. By the end of this video, Domain C is complete. You will have everything you need across both parts of the exam, which will cover total 36 questions, and you will have to address it with confidence. Let me start with a question. What is actually the purpose of suspicious activity monitoring? The answer is straightforward. It's a mechanism that converts your compliance program from a documentation exercise into actual financial crime detection. Without it, you have policies, procedures, and training, but no way of identifying the criminal activity happening right in front of you. The process has 4 stages: detect, investigate, escalate, report. And each stage has specific obligations. Let's look into it one by one. The first one, as I said, it's detection. Detection happens in 2 ways. First, automated. Your transaction monitoring system rules and thresholds in the background, generating alerts when transactions fall outside the expected patterns. Second is the manual. Your relationship managers and frontline staff observe customer behavior and flag anything that does not feel right. The red flags you are looking for include unusual transaction size, structuring multiple transactions, deliberately kept below reporting thresholds, unusual geographic patterns, and any transaction that's inconsistent with what the customer told you they would be doing when they opened the account. The second thing that we have is the investigation. When an alert is generated or a frontline flag is raised, you investigate, and this means reviewing the customer file, not just the flagged transaction. You are looking for patterns across the relationship. One unusual transactions might be explainable. A series of them following a consistent pattern is a different matter entirely. If you need to gather more information from the customer, and sometimes you do, you can ask, but you must not signal that a suspicious transaction report is being considered. We'll cover that in the tipping off section. Document everything: what you looked at, what the customer said, what you concluded. If a regulator ever reviews this file, the documentation is your defense. Let's look at now escalate. Once your investigation is complete, it goes to the compliance officer or the money laundering reporting officer in many jurisdictions. They review the findings and make the decision. File a suspicious transaction report or close this matter with a documented rationale. Do not delay escalation unnecessarily. Time matters. And for high-risk situations, a potential terrorist financing case, for example, senior management involvement, is required. The last is the reporting. If the decision is to file, the report goes to your National Financial Intelligence Unit, which is FIU. It must contain the customer details, the transaction details, and a clear statement of why you are suspicious. Timing requirements vary by jurisdiction, typically between 24 and 72 hours from the decision to report. And filing the report is not the end. You continue monitoring the relationship. Do not treat the suspicious transaction report as closure. It's a notification to authorities, not a resolution. Let's talk specifically about what triggers the obligations to file, because this is one of the most important and tested concepts in Domain C. Generally, a threshold is a suspicions. You file when you know, suspect, or have reasonable grounds to suspect that a transaction involves proceeds of criminal activity. You file when a transaction has no apparent lawful purpose and you can find a reasonable explanation after investigation. You file a customer's behavior or account activity is inconsistent with the profile you established at onboarding. Here's something that candidates frequently get wrong. A customer who terminates a relationship or suddenly withdraws funds after being asked due diligence questions, that in itself can be grounds for suspicion. The behavior is response to legitimate compliance questions tells you something. 3 rules you must know. First, you do not need proof to file. Suspicion is enough. If you wait for certainty, you will never file anything and the criminal walks away. Second, filing a report does not mean the customer is guilty. It means you had a suspicion and you fulfilled your legal obligation to report it. The FIU and law enforcement will determine what happens next. Third, you must not tell the customer a report has been filed. This is the tipping off rule, and we are going to spend the next slide on it because it's crucial. The report must contain some key information such as customer identification, why it is suspicion, details of transactions. I have provided a link to an excellent document on how to write a suspicious activity report. The link is provided in the description. The 2 rules work as a pair. Safe Harbor protects you when you do right thing. Tipping off can prosecute you when you don't. Let's look at the first one, tipping off. Tipping off means disclosing to a customer or any third party that a suspicious transaction report has been filed or that an investigation is underway. It's a criminal offense in most jurisdictions, not a policy breach, not a disciplinary matter, a criminal offense with potential imprisonment. Why is it so serious? Because if you tell a subject of a report that they are under investigation, they can destroy evidence, move funds across borders, or disappear before law enforcement gets anywhere near them. You would be actively obstructing a financial crime investigation. What counts as tipping off? Direct disclosure is obvious, telling the customer outright, but indirect hints count too. Unusual delays in processing that clearly signals heightened security. A tone change in how you speak to the customer, telling a colleague who doesn't need to know. All of these can constitute tipping off. Here's the exam trap that catches people out. A compliance officer who tells a customer their account is under review even without mentioning the suspicious transaction report specifically can be guilty of tipping off. The disclosure of the investigation in itself is this offense. What doesn't count as tipping off? Disclosing to your compliance officer, disclosing to your legal team, disclosing to another regulated institution as part of a legitimate due diligence process. But this one has very strict limits and you need to understand the conditions before relying on it. The next thing is the safe harbor. So safe harbor is the protection granted to you and your institution. When you file a suspicious transaction report in good faith, it means a customer cannot successfully sue your institution for filing a report about them, even if no criminal prosecution even ever follows. Think about what that means in practice. Without safe harbor, compliance staff would face legal risk every single time they filed a report. The customer could claim defamation, breach of confidentiality, economic harm. The whole reporting system would collapse because no one would file anything. The good faith requirement is critical. The report must be filed honestly, based on genuine suspicion. It cannot be used as a tactical tool, filing a report to exit a relationship you don't want rather than because you genuinely suspect financial crime. That crosses the line, and safe harbor won't protect you from there. Record keeping is not a filing exercise. It is a legal obligation with direct consequences for the institution and the compliance officer if it fails. There are 3 categories of records and each has its own retention period. The first one is customer due diligence records. Everything you collected to identify and verify customer, such as identification documents, verification evidence, beneficial ownership information, risk assessment, enhanced due diligence documentation, senior management approvals, all this must be kept for 5 years from the end of the customer relationship, not from the time when you collected it, from when the relationship ends. The second thing is the transaction records. Every transaction on the account, sufficient details to reconstruct exactly what happened if authorities ever need to investigate. Counterparty details, currency, amounts, date, channel, and any supporting documentation provided by the customer. 5 years from the date of transaction. Suspicious transaction records. Copies of every report filed, the investigation documentation that led to the filing decision, evidence reviewed during the investigation, the decision rationale whether you filed or not, and communication with the FIU. 5 years from the date of the report. And here's an important rule that sometimes surprises people. Suspicious transaction report records cannot be destroyed while an investigation is ongoing, even if the 5 years retention period has passed. If authorities are actively investigating and need the records, you must preserve them. Electronic records are acceptable. They must be retrievable. They must be legible. And they must be available promptly to competent authorities on request. Promptly, not after a lengthy internal retrieval process. Sanctions is one of the most high consequences area in the financial crime compliance. A single breach, such as processing a transaction for a designated person or dealing with a sanctions jurisdiction, can result in criminal prosecutions, fines running into billions, and reputational damage that takes years to recover from. There is no risk-based approach to sanctions in the way there is to customer due diligence. You do not apply enhanced scrutiny to potential sanction hits. You freeze and report, full stop. Let's look at what are these sanctions. Sanctions are restrictions imposed by governments or international bodies on specific individuals, entities, sectors, or entire countries. They are a tool of foreign policy and national securities. The bodies that impose them include the United Nations Security Council, whose sanctions have global reach and apply to all members. OFAC, the Office of Foreign Assets Control under the US Treasury, whose sanctions have extraterritorial reach, meaning that they can affect non-US institutions dealing in US dollar or with US counterparties. The EU, the UK's OFSI, and national regulators in individual jurisdictions. Targeted financial sanctions freeze the asset of specific designated persons and entities and prohibit anyone from dealing with them. Sectorial sanctions restrict specific industries such as energy, defense, finance in a targeted jurisdiction rather than prohibiting all activity entirely. The second is the screening obligations. You screen at onboarding, at every transaction, when sanctions lists are updated, and list can be updated at any time with no advance notice and periodically throughout the relationship. What actually you screen? Customer names, beneficial ownership, counterparties, correspondent bank, and in the trade finance transaction, specifically vessel names. Name matching is more complex than it sounds. Exact matches are straightforward, but names are often transliterated differently across different languages and documents. A name that's one letter different from a designated person is still a potential match and must be investigated, such as true match versus false positive. This is where many candidates lose marks. A true match is a genuine sanctions hit. The customer or counterparty is on the designated list. You freeze the transaction, you do not process it, and you notify your regulator and the relevant authority immediately. A false positive is a name similarly that on investigation does not relate to a designated person, but you cannot simply clear it without investigation. You must investigate, document your analysis, record why you conclude it's a false positive, and then clear it with that documentation on file. The exam will give you a scenario with a name match. Your first task is always to determine true match or false positive. The correct response depends entirely on which one it is. Here's something I have seen in real institutions. A beautifully written AML policy that nobody understands because nobody was properly trained on it. A policy without training is just words on a page. Training is what converts that compliance framework into actual behavior on the ground. And the CAMS exam tests whether you understand who needs the training, what level, and how often. Let's look at the first thing that we have it. Board and senior management, who sets the tone indeed. The board needs training. That surprises some people, but it shouldn't. Senior management are personally accountable for the compliance program. They sign off on the risk assessment. They approve the compliance budget. They receive the compliance officer's reports. If they don't understand what they are looking at, they can't fulfill their accountability. Board training covers the institution's financial crime risk exposure at a strategic level, regulatory expectations at governance level, their personal liability under anti-financial crime law, and high-profile enforcement cases, because nothing focuses the mind of a board member like seeing what happened to their peers at another institutions. That's minimum annually. Compliance and the AML staff. Full technical training. This group needs to understand the regulations in depth, the typologies, the suspicious transaction report process, end to end, sanctions screening procedures, and regulatory changes at a very detailed level, ongoing with a formal annual training program as the minimum baseline. Frontline and the customer facing staff. This is the group that has the earliest opportunity to detect financial crime and the least technical training in the institution. They need to know how to identify suspicious behavior and red flags relevant to their specific role. They need to know when and how to escalate. They absolutely need to understand the tipping off rule because they are the ones most likely to accidentally breach it by saying the wrong thing to the customer. New staff must be trained before they commence customer-facing duties, not after. It must be before. And training records must be kept. If a regulator asks who was trained, when, and what they were trained on, you need to be able to provide such evidence. The compliance officer is the most important individual in the institution's anti-financial crime program, and the exam tests very specific things about this role, particularly around independence. In many jurisdictions, this person is called the money laundering reporting officer. Whatever the title, the function is the same. They are designated by the institution as a person responsible for anti-financial crime compliance. They receive internal suspicious activity escalations and decide whether to file externally. They oversee the design and implementation of the program. They liaise with regulators, law enforcement, and the FIU, and they report directly to the board or senior management, not through the business line. This is to maintain the independence, which is the next thing. So the compliance officer must be sufficiently senior to have a genuine authority within the institution, not just on the papers, in practice. They must be able to challenge a business decision, delay a transaction, or refuse to approve an onboarding, and have that decision stand. They must have a direct access to the board. A compliance officer who has to go through a business line head to reach the board has compromised independence. That's the structural failure, not a personal one. And regulators will call it out. They must not be placed in a position where business targets conflict with the compliance obligations. Giving a compliance officer a revenue target is a conflict of interest. It creates pressure to approve things that should be declined. And they must have adequate resources, staff, systems, and budgets. A compliance officer who is told to run a program with insufficient resources is being set up to fail, and the institution is being set up for a regulatory enforcement action. They are personally liable. This is one that really gets people's attention. The compliance officer can be held individually accountable for failures in the program. Regulators in multiple jurisdictions have pursued compliance officers personally, not just the institution, where there was clear evidence of negligence or deliberate failure. Here's the exam scenario you need to be ready for. A compliance officer is pressured by a business head to clear a suspicious transaction report because the customer is commercially important. If the compliance officer complies, not because they have genuinely cleared the suspicion, but because of commercial pressure, they face personal legal risk. The business case does not override the legal obligation. Know the difference between compliance officer role and the internal audit role. They are separate functions with separate reporting lines. The compliance officer runs the program, internal audit tests it as a third line of defense. They should never be the same person. A compliance program without internal controls is a belief system. With them, it's a system that can be tested, measured, and improved. The framework most widely used in the industry and referenced in the CAMS exams context as well is called a 3 lines of defense model. The first line of defense is the business. The business units and the frontline staff owns the risk. They implement the controls, they conduct customer due diligence, they file escalations, they are responsible for day-to-day compliance with the program. If something goes wrong at the first line, the question is, did they follow the procedure and was the procedure adequate? The second line of defense is the compliance and risk. The compliance functions design the framework. It monitors and oversees the first line. It provides guidance and interpretations when frontline staff face uncertain situations. It conducts compliance testing, sampling customer files, review suspicious transaction reports, decisions, checking that training has been completed. And it reports to senior management and the board on how the program is performing. The third line of defense is the internal audit. Internal audit provides independent assurance. Its job is to test whether the controls in the first and the second lines are actually working as designed, not just whether they exist on paper. And critically, internal audit reports directly to the board, not to the compliance officer, not to the management, to the board. That independence is essential for the audit function to be credible. When internal audit finds a problem, the finding goes to the board. The compliance officer receives it and a remediation plan is required. The board tracks the progress until issue is resolved. Let's look at, there are 6 key control elements together now. With this framework, the specific controls that must be in place includes written and current policies and procedures that are accessible to relevant staff, an automated transaction monitoring system with a human review. The system generates alerts, but a human being makes the decision. A customer risk rating that drives the level of due diligence applied, not just a label that sits on a file. The next one is the management information reporting to senior management and the board on the key risk indicators. The last one is the independent testing by internal audit on an annual basis at a minimum. That's the domain C. Both parts are now complete. Let me give you a quick summary of the full picture. Part 1 covered actually the customer obligations, the risk-based approach as the foundation, the 3 levels of customer due diligence, customer identifications and verification for both individual and legal entities, beneficial ownership with the 25% thresholds and both routes, source of funds versus source of wealth, the 3 categories of PEP, and the full politically exposed person's life cycle from identification throughout up to the former status and ongoing monitoring throughout the relationship. Part 2 covered the program obligations, suspicious activity monitoring across all 4 stages, the suspicious transaction report and what triggers it, tipping off as a criminal offense and safe harbor as your protection, record keeping with the 5 years retention periods, sanctions screening with the critical distinctions between true matches and false positives, staff training obligations across all 3 levels of the institution, the compliance officer role with independence as the non-negotiable requirement, and internal control through the 3 lines of defense framework. There are 36 questions, 2 videos that you have to watch. You now have everything you need to handle all of them. Now let's look at how to study domain C part 2. There are 3 things that you have to do in this part. The first one is the master the critical rules. Suspicion not certainly triggers the filing obligation. Tipping off is a criminal offense, not a policy breach. Safe harbor requires good faith. The compliance officers must be structurally independent from the business. These are the rules the exam test through exam scenario questions. If you cannot state each one clearly and briefly, you're not yet ready. Second, know the key distinctions. True match versus false positive. The response is completely different and the exam will test which one you chose. Compliance officers versus internal audit. Separate functions, separate reporting lines, never the same person. A transaction monitoring alert versus a suspicious transaction report. The alert is the start of the process, not the end. Targeted financial sanctions versus sectorial sanctions. Different scope and different obligations. Third, practice by making decisions. Every domain C scenario ends with a question about what you would do. Work through it systematically. Is there a suspicion? Yes or no? If it is yes, file. Can you tell the customer? You cannot because it's a tipping off. Is this sanctions match? Is it true or false? What's the next step? Train yourself to move through this logic quickly and consistently. The AdviseCube questions bank has over 1700 scenario-based questions across all 4 domains. Domain C questions specifically are built around this format that I have described. A situation, a decision, and 4 to 6 options. That's exactly how the real exam works. Before we wrap up, a quick word about AdviseCube Consulting. Everything we have covered in both parts of Domain C is in the practice question bank. We have over 1700 scenario-based questions written to match the difficulty and the format of the actual exams. Domain C questions are built around real compliance decisions. You read the situation, you assess the risk, you choose the correct response. That's the exam. That's what the question prepares you for. The study notes that we have prepared cover the material across multiple financial crime certifications written for people who study around a full-time career. These are concise, no padding, only what matters. The full range is available at AdviseCubeConsulting.com. We have additionally designed an e-learning course which will give you a complete study from end to end. You do not need a trainer because it has an AI bot trained specifically on CAMS material. You can ask it anything at any time. What's the difference between tipping off and safe harbor? What happens when internal audit finds a control failure? What's the correct response to a sanctions false positive? Immediately you will get an answer for all such questions when you ask the bot during your e-learning course, any time of the day. That's what it's there for. Visit AdviseCubeConsulting.com or message us on WhatsApp. The number is on your screen now. We're also available on the email, which is info@AdviseCubeConsulting.com. That's domain C, done and dusted, both parts. Domain D is the next, and I'll be honest with you, it might be the most relevant to your actual daily work. Domain D covers the tools and technologies we use to fight financial crime. Transaction monitoring systems, AI and machine learning in AML, blockchain analytics, sanctions screening technology, regulatory technology, and data analytics. If you work in a modern compliance function, you are already using some of these. This video will show you how you connect to the exam. If this video was useful, please like it. It genuinely helps us, the channel, to reach out to more people who really need this content. Subscribe if you haven't already. Domain D is coming soon and you don't want to miss it. And leave a comment which topic in Domain C did you find it hardest? Tipping off, the compliance officer independence rules, the 3 lines of defense. Let me know. I read every comment and it helps me understand where to go deeper in the future videos. I'll see you in Domain D. Thank you so much.